QuickBooks Online 2025, entering an invoice form. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are online in our browser searching for that QuickBooks Online test drive, the free sample company file available to everybody, looking for the result that has intuit.com and the URL. I'm going to be using the United States version of the software and verifying that I'm not a robot. If you are a robot, then again, you're going to have to either lie about it or you just can't use the QuickBooks Online test drive. That's just the way it is. That's up to you to decide. I won't judge you on it. In any case, we're in the sample company file, Craig's Design and Landscaping. I'm going to close the prior tab, it no longer being needed. Opening the major financial statement reports on the left-hand side. Under the standards, we want to right-click on that balance sheet to open a link in a new tab. Right-click on the profit and loss to open a link in a new tab. Then we'll go to that middle tab, close up the hand boogie, change the range. I'm going to go for a 2-year range, 010124 tab 123125. Select the drop down, see it on a year by year, run it to refresh it. 2024 and 25 now side by side. Let's tab to the right and repeat the process. Closing the hand boogie, changing the range in 010124 tab 123125 tab, dropping down for the years. And then run it to refresh it, noting that there's nothing in 2025 except for that $34 at this point in time. And that includes prior transactions that we have entered because we're refreshing, logging out, logging back in, possibly using incognito window if we need to. If you want to follow along, you might want to do the same thing. Otherwise, the other transactions that we entered in prior presentations might not bother you too much, will be okay. Let's go to the first tab. We're going to select the plus button. We've been looking at the cycles within cycles within cycles of the accounting system. This time we're looking at the customer cycle, which you could also call the accounts receivable cycle, the sales cycle. It's the cycle that ultimately results, hopefully, with money coming into the company from the main source of money coming in, that from customers for goods and services that we are providing. So we talked about the flowchart last time, meaning we can structure many different types of businesses or imagine the cycle being different depending on the industry that we are in. Remembering that as a bookkeeper, we want to think about what industries do we want to specialize in, and then what industries do we not want to be picking up because they might not fit as nicely into our job system that we have put together. So if we just had a system that was basically the easiest system, like gig work that was coming through, you're getting paid by YouTube or something, then you could just wait till it comes through the bank feeds. Or if you're at a cash register, you got to think about, do I want to set up a system where I can record the sales receipt at the cash register? And then if you're tracking accounts receivable, that's when you're going to have to use the invoices. That's when you do the work first. Then you're going to have to typically invoice the client. Then you're going to have to track the accounts receivable that are outstanding to make sure that they pay you. Because if you don't do that, a lot of times people won't pay you. Don't think just because you know them or they're your friends or something that they'll actually pay you for the work that you do. Maybe it depends on who your friends are. I don't know. So you still have to follow up on the receivables is the point here. So in any case, let's go into the invoice type form and check it out. Quick rundown on the fields. I'm just going to tab through them. So I'm going to put my cursor on the first tab. Notice we have the drop down of the customers. That's who we're going to be charging for the work that we are doing. Remembering that this would be classically used an invoice in something like a job cost system. If you're a bookkeeper, if you're a law firm, or something like that, or in this case, a landscaper, in which case that industry is one in which you just basically have to do the work first. You can't just choose, in other words, to say, hey, look, I don't want to be on an accrual basis. I want to be on a cash basis. That doesn't work if you're in an industry that happens to need to track accounts receivable, because that's going to force you to be on an accrual basis, as we see here with our landscaping business. So we would put in the customer. The invoice is a form that we would want to be giving to external users, remembering that the forms themselves do not necessarily mean things that we're going to print out or things that we're going to email all the time to other people. They're the data input forms. They're the things that are going to make the data input as easy as possible for us to then use them to enter and create the journal entry that will impact the financial statements, balance sheet, and income statement. But some forms will be documents that we're going to give externally, as is the invoice here. Therefore, it's one of those forms that you might want to customize just to get the look and feel of it look nice, put your logo on it and all that kind of stuff, which we talk about, I believe, in another course or section. We're going to focus on the data input and the journal entry here. So we've got the billing address. If we need to send out the invoice, that becomes particularly important, but oftentimes these days might not be as important because we can just basically email it possibly. We've got the terms. Now we saw the terms on the bills because the bills are related to the accounts payable. This is related to the accounts receivable, but the terms are most likely more useful for an invoice because on the accounts payable side, the terms are going to be on the bill, meaning I'm not going to really put the term which will tell me when something is due from the date I enter a bill because it's going to be, I'm just going to have to enter the due date of the bill oftentimes. But with the invoice, we are creating the terms. So we're saying, hey, look, I'm going to enter the invoice as of, in this case, 1/6. And if I say it's net 30, that means that we expect to be paid within 30 days. That's going to be important when I sort the accounts receivable so that I can sort by the accounts receivable that has been paid, the accounts receivable that has not been paid but possibly isn't still due, and the accounts receivable that are overdue, possibly sorting in those formats and then sending out notices to say, hey, look, could you guys pay us over here on the accounts receivable? So we can add terms if we need to as well. Then we've got the invoice date, which most likely is the date that you're entering the invoice most of the time. And that means that the due date should populate fairly nice and easy because it's just going to be according to the terms. If the terms are 30 days, it's going to give you the end date automatically 30 days later. Tags are going to be a special tracking function, and we talk about them in another course or section. It's kind of a specialized area that could have multiple different uses. The products and services. These are the things that we are actually selling. So if it was a product, they're invoicing. They are items that we would have to set up, inventory items, which if we're doing inventory, we have to remember, are we tracking the inventory physically in QuickBooks using a perpetual inventory system, or are we not using a perpetual inventory system? And then if we're using a service business, then we're going to have the service item in here, such as if it was a guitar, a auto repair shop, we might have oil change and rotating the tires and so on and so forth. Noting that if you're in a law firm or bookkeeping establishment, you might just have hourly items as your service, and then you're going to put the quantity of hours charging at an hourly rate. However, I would highly suggest thinking about is there a better way to do it, right? Is there a better way to do than hourly service? Because I think in a lot of cases, people appreciate if they can have something more tangible than just the hours that you put in. So for example, for bookkeeping, I would highly suggest that you might want to think about billing based on maybe the number of transactions that you enter. So if I enter more than so many transactions, I can actually print out and count the transactions and see them, or how many accounts are affected, and so on. If you're a law firm or a CPA firm, you might actually charge just a standard rate, and then you might have more or less law services, but you're going to, during a period, but you're going to charge a fixed rate to have them covered, kind of like insurance. And some law firms might do that kind of system. But if you're picking up case-by-case situations in a law firm, or you're working with the IRS or something, you have no idea how long it's going to take. The only way you can really do it is kind of hourly at that point. So then we would enter the hours here. We can add lines. We can clear the lines. We can message on the invoice if we want to add something to the invoice. We have the message on the statement. We can put attachments in place. We can cancel, clear, print, or preview We can make it reoccurring. This might be useful if we had something such as a prepayment situation. In those situations like the newspaper, or most likely these days applications where we get the money before we actually do the work, we might then put them in place as a prepayment and then possibly make reoccurring invoices that will record the revenue as we earn it, as time passes, as they have use of the applications or the newspaper hits their window. That's kind of a specialized area. We have the customize situation. This is a form that is subject to customization because, again, you're giving it externally. So you might want to put the logo on it and that kind of stuff. We could save it, and then we can save and send, save and close, and so on. This is going to be the totals. We'll get into the calculation here, but just note for now that you're going to have the total of how much we charge, and then we're also going to have to deal with the idea of taxes, sales tax in the United States, which is a type of consumption tax, and that will complicate the journal entry. So before we enter one, let's close this out and deconstruct one and say, where does this go? Do you want to leave? I'm going to say yes. Let's go to the balance. Let's go to the balance sheet, the second tab, and I'm going to scroll down. The invoice is going to impact accounts receivable. Let's go into the accounts receivable for 2024, noting the activity in it is going to be standardized in that invoices will increase accounts payable and payments will decrease accounts payable. Payments being payments on the invoice by customers that we're going to receive, payments that could be in the form of cash, credit card, electronic transfer, and so on. So that's all that happens in accounts receivable. Remember that cash, the first thing we think about oftentimes when drilling down on, this is called like the general ledger, which in QuickBooks is the transaction report. When we think about cash, we often think that this general ledger is going to be a mess of all this complicated types of forms. But every other account other than cash, because cash is the lifeblood of the company, is usually much more simple. And the form types over here are only going to have two form types, an invoice and then a payment. So it's going to go up with an invoice, down with a payment. Let's go into an invoice. I'm going to go into one of these invoices, drilling down to the source document. We're basically taking apart the engine. We're starting at the end, the financial statements, drilling down to the source document, the thing that we put together to build it. And once again, we see the customer, the email, the billing address, the terms, and so on. This is what we sold here. So we've got landscaping and pest control. Here's the quantity. And then here is the amount that was charged. So what did this particular item do in terms of journal entries? It increased the revenue account. Well, it increased accounts receivable by the 175, and it increased revenue by 175. Where did the revenue go? How do I know which account was hit by the revenue? Shouldn't the account be in here somewhere? Well, the account's being driven by the item. So that's going to be the sticking point or the kind of confusing component. The items are the things that we're selling. Those are critically important because that's the thing that's going to tell us, one, is this item subject to sales tax? Typically, that's the thing that's going to tell us that. And two, what account is it going to go to on the income statement, right? And that's going to be driven by the item. If I close this back out and we go back, if I go to the income statement, then the income accounts here, this is where the other side is going to go. So if I go into like design income, let's say, then you can see that it is going up with invoices and sales receipts. So all of the income accounts, if we're on a full service accounting system, will go up with the income forms, invoices for an accrual basis, sales receipts if you're at like a cash register or cash basis. But sometimes if you're in a more simplified system like the gig work situation, you're getting paid by YouTube, you might increase revenue with a deposit form, which is not really the natural form that we think about to increase, but that might work in some cases. All right, so that's going to be the idea. Let's go ahead and go back to the first tab. Now, as we track these invoices, remember that we have to try to collect on them. That means if we deal with accounts receivable and invoices, we're going to have to go into the sales center from time to time. most likely then going to the Invoices tab and tracking the invoices so that we try to collect on them. We can also search this and deal with our customers individually by going to the Customer tab and looking for the invoices in there. So this is if you were dealing with a cash register situation, you wouldn't be in here as often. All right, let's make one and check it out. So let's go and enter a more simple invoice and one that doesn't have inventory, and then we'll deal with inventory. So let's say this is going to be customer one, just generic customer one. We're going to say, okay, now I'd enter an email if I'm going to email it to them, but I'm just going to have generic customer. I'd have to enter their billing address if I was going to send it to them, which means when I set up the customer, I would need more than just customer, but a lot of other information, noting that if you're in the type of industry that you are actually sending out invoices, it's possible that you are more likely to have repeat customers, such as a bookkeeping or law firm or landscaping, in which case you probably want more information from the customer, their telephone number, their email, their address, if you can get it. Give them your mailing address, even personal information, so you can talk to and communicate with the customer cordially, right? Whereas if you're at a cash register or if you're on a Shopify store or something like that, then you don't really do that. It's kind of counterintuitive because a lot of times people want to build their network, and it becomes this massively important thing to think about how many people you're connecting with just as a game almost. I have connections with all these different people, but in sometimes some businesses that's actually counterproductive because you're only if you're selling like some toy or something on a Shopify store, you're not trying to build a long-term relationship with a particular customer. You're trying to satisfy them with that one particular transaction to the point that they're happy with the service and possibly talk to other people about that one particular transaction. You're not contacting them and talking to them about how their kids are doing and this and all that kind of stuff, right? Whereas if you're a CPA firm or even a hairstylist or doing nails, or you're a law firm or a landscaper, then you are going to be dealing with people on a personal basis, and the networking on a personal side can become, part of your whole life and your whole, accounting system. So in any case, so then we're going to say the terms, we'll keep it at net 30. I'm going to put it in there. We'll keep it at the 1/6. So the due date is going to be 30 days because it's net 30. I'm not going to deal with the tags at this point. I'm going to make a new item. I'm just going to call it service item 1. So I'm going to set up an item, and I'm going to set it up as we go. Not an inventory this time, not a non-inventory, but a service item. So that means there's no inventory involved. So it might be hourly services would go into that category, or oil changes and that kind of thing. Let's put the classic $100, and the income account is automatically going to a service account for income. So we'll say, all right, we'll keep it there at the service account. And okay, let's close it up. Let's say that we did 2 of those, whatever services. Now, is it subject to tax? I'm going to say it's not subject to tax, which I should have been more careful on setting up the item to say it is not subject to tax, because I want that to populate automatically. So, but I'll uncheck it at this point. And then down below, we have all these items. Now, if I had multiple service items, I can add multiple lines, of course. But what's this going to do from a journal entry standpoint? It's going to increase accounts receivable by 200. It's going to increase the revenue account, which we're driven to the service item, by 200. And it's going to impact the subledger for breaking out who owes us money by customer, in this case, customer 1. Let's look at that just from an Excel standpoint, just so we can see it in a transparent format. A simple invoice, what's it going to do? Accounts receivable is going to go up, and that's going to be a debit if you want to think about debits and credits. The other side is going to go to some kind of income account or revenue account on the income statement. We put it in here for 200. So accounts receivable is going to go up with a debit of 200, and income is going to go up. I'm going to put a credit. Negative here doesn't mean negative income. It means a credit. So we have a positive net income because it's income minus expenses of 200 on the income statement. This part is the income statement. And then up top, we have an asset of $200. It's not cash, but hopefully it's close to cash because hopefully our clients aren't deadbeats and they'll pay us, and then we'll get the cash, which means we'll decrease the accounts receivable. So that means that this accounts receivable account is an accrual account because we're recording revenue before we get the cash. We have to do that because I need the accounts receivable on the books, because that allows me to track the accounts receivable to see who has not paid me and then go out and collect on it, which means I'm going to need a subledger for this accounts receivable by customer so that I can track the payments. Let's check that out over here. So if I record this, I can say save and close and say, ¿Qué pasó? What happened to the financial statements? Let's go to the balance sheet, run it to refresh it. And then we'll go down into the AR for 2025 this time. And there it is. So there's our invoice. So we increased by 200. Let's go into that particular invoice. And there it is, customer and so on, $200 went up. Looks good. Let's close it out. Let's go back to the prior. Let's go to the profit and loss, the P&L, the income statement, run it to refresh it. And they put it into the service income. Notice there's more income accounts than normal here because it's a job cost system. So we put it in, here it is down here, services. So there's the 200. So we increased the income statement by the 200. Now this balance sheet account has income or assets in it that I need to collect on. So I could look at that from a subledger perspective. So if I go to the first tab and we go down to our reports, then I could look for by category who owes you. Normally we'd look at an aging, but let's just look at the classic subledger, which would be a customer balance detail. I'm going to right click on this one, open in a new tab, and here we have it, closing up the ham boogie and running it. So now we've got the accounts receivable not broken out by date, as is the general ledger or transaction detail report when we drill down on an account from the balance sheet or income statement, but this time broken out by customer. So we can see here's customer one, there's the 200. If I add up all the customers that owe us money, 5,481.52 should tie out to what's on the balance sheet, 5,481.52. Notice that in QuickBooks, those two things will almost always tie out, and you have to work pretty hard to mess that up because QuickBooks will force us every time we post something to accounts receivable to add a client or customer so that the subledger will always tie out. Other software, more advanced software, or customizable software won't do that because there are some times that you don't want that to be the case. And if that happens, if those two things are not tied out, something's wrong. That's a problem. Now, normally you don't actually go into this report all the time because if you're in the accounting department, you're going to be going internally into the widgets on intern. So if I go to the left, in other words, I would be in the sales center and I could check the invoices in multiple places. I could go to the sales, all sales, and I could sort this by saying, these are all of the documents. I want to look at invoices. These are all of the forms that are under the customer center in essence. I'm tracking and filtering by invoices, in other words. And then I can look at the status for open because this one is open. And then now we have the open ones. There's our customer. But more likely, if I'm in the invoices, I have a whole nother tab over here for invoices. I can go into it and look at the overdue ones, but mine isn't yet overdue, not yet due, and then we can sort it this way. There it is. Or we can go into our customers, sorting not the forms of the invoices, but by customer, and once again, look for the open invoices. So now I can see all the customers that have open invoices. And this is useful because I might want to periodically, most likely I would want to periodically, send out statements to all of the people that have at least overdue invoices saying, hey, could you pay us on the invoices? Or just as a friendly reminder that, we did some work for you and like you haven't paid us. And, I just thought we would follow up on that and so on. All right. So now also note that the product that we set up is over here. So here's the product that we set up, and once again, I would want to change the product that we set up so that it's not subject to see how it's subject to the taxes. I want to uncheck that so that it's not subject to the tax. So I go into sales tax and say it's non-taxable. So that means when I populate it, I won't have to uncheck the tax button. All right, let's do the same thing now, but this time let's say that there's an inventory item, which means I need to track inventory. Now, if you're tracking inventory, there's a couple ways that you could do it. If you were tracking inventory and you had like well, let's just think about it over here on our flow chart. This is a desktop flow chart, but again, we're using it just to look at the forms. So if you're tracking inventory and you're going to invoice someone, you might say, well, what would be the easiest thing to do to track the inventory on like a cash method, even though you're doing an accrual form for accounts receivable? But you might be saying, hey, look, I'm buying stuff for a particular job. Although it's inventory, I'm going to be using it very soon. Therefore, when I buy the inventory, I'm just going to expense it as cost of goods sold when I buy it. And then when I create the invoice, even though I'm selling inventory, I would only record the sales side, not having to deal with cost of goods sold or sales at that time. However, if you hold on to inventory for any period of time, you're going to have to put it on the books as an asset, which means that you either use a periodic inventory system or perpetual inventory system. If you use a periodic inventory system, there's less setup work in QuickBooks, possibly because you track inventory physically just on an Excel worksheet, or possibly on like a Shopify store in Shopify or Amazon and so on, in which case you would possibly track all of that physical unit information on the external site. And then when you record the revenue in QuickBooks, again, you would do some kind of journal entry or just record the sales side of things, not recording the reduction of inventory and cost of goods sold at that time, but rather periodically doing that with a journal entry based on a physical count that you would do at the end of the year, end of the quarter, end of the month, end of the day, end of the week, depending on what you're doing. If you're doing a full service system, however, then when we buy the inventory, we're going to increase not only the dollar amount of inventory, but the units of inventory with a subledger in QuickBooks. Then when we sell the inventory, we're forced to either use an invoice or sales receipt instead of a deposit form, because these are the two forms that will allow us to decrease the inventory as we sell it on a perpetual or as we go basis. Let's see what that would look like on a perpetual inventory system. So let's go to the first tab, and we're going to say another invoice. Let's just call this customer 2, customer 2. And then we're going to say, I'm just going to generically set that one up again. And let's say this one happened on the 7th, just to change it up a bit. And I'm going to say this is going to be inventory item 1, which I misspelled, but I'm just going to just go with it. This time it's an inventory item. I'm trying to rush it a little. I'll fix the spelling because I'm running long on time. I don't want this to last forever. It's already been forever, dude. Can't you do it any faster? If I go too fast, then people complain that I talk too fast. As of date, we'll just say, you can't win, man. You can't win with people these days. I'm telling you. So I just do what I doing my best, okay? This is going to be for $200. Let's make it $150 sales price. It's now going to go not to the service item, but to the sale of product item. We're going to allow the sales tax to calculate this time, because oftentimes in the United States, the sales tax will be on these items, and then the cost, if we sell inventory, let's make, is $100. So we buy them for $100, we sell them for $150. We could put the preferred vendor, which, but I'm not going to. So I'm just going to say that's who we buy them from, not who we sell them to. Now we're dealing with an invoice, so I'm actually going to have to put them on the books because we don't have any on hand right now. So let's say I'm going to put there's 5 on hand. When I say there's 5 on hand, QuickBooks will actually make a journal entry to record those 5, which will be an increase to inventory, and the other side's they're going to have to put the other side, somewhere for the purchase price. So it's actually going to record a transaction. So be careful when you do that. But I want to put them on hand so I can sell some of them. Let's save it and say, all right, we saved it. Let's close this out. And then we're going to say, let's say there's 5 on hand now, you can see, right? And so I sold 2 of them. And let's say, so that's going to be a sales price of $300. Sales tax is being applied with the check mark, which is driven by that item, noting that we talked about the fact that we would have to set up the sales tax in order to get that in place, which we'll talk more about in the second half of the course. And so what's the journal entry here? This is the point we want to get at. We're selling it for $300, but now sales tax is being calculated at $24 because it's 8% sales tax. The rate will change depending on where you're at. We'll talk more about that later. But just from a generic standpoint, what's that going to do? Well, that means that we're going to have to collect $324. So it's an invoice. That means accounts receivable is going to go up by $324. The other side's going to go to revenue, but it's only going to be for $300, not including the sales tax. And then the sales tax is going to increase a payable account for like sales tax payable, a liability. Not only that, but accounts receivables, but the inventory is going to go down, not by the $300, but by the cost, which I think we said was $100, so it would be $200 for 2 of them. And the cost of goods sold, the expense is going to go up. So the impact on net income is going to be $300 minus the cost of goods, minus the inventory or cost of goods sold, which is $200. And we're going to have the subledger that's going to break out the information by customer, in this case, customer 2 for accounts receivable, and a subledger for the inventory, which is going to record the reduction of inventory. So let's see if we can see that from a journal entry over here. So I'm going to put the inventory on the books again. I'll just imagine that we had like 500 of inventory, and I'll put the other side into equity as our starting point. So what's this going to do from a journal entry? What are the accounts that are affected? Usually we can break it out into 2 sides, even though they're happening at the same time in a perpetual inventory system. So accounts receivable is going to go up, and the other side is going to go to income, which I'm just going to put generically income this time. And we said accounts receivable is going to go up by, this is going to be what did we sell it for? We sold 150 times 2 times the sales tax, which I think they had at 8%, which is 1.08, 108%. So that means we're going to collect 324, right? 324. But the sales side is only going to be equal to, I'm going to say negative for a credit, 150 times 2. And then the sales tax is going to be a liability account, which is going to be the difference, negative sum. That way I could do it. Or it's going to be equal to the negative 150 times 2 times the sales tax, which is 0.08, 24. So this ties out. So debits equal the credits. And then I'm also going to have the cost of goods sold and the inventory. Cost of goods sold and inventory, which I can think of as another transaction in essence. For the inventory is going to go down by the cost, which was, 100 times 2. And so there it is. So let's think about this one. So, okay, now accounts, so I'm going to say accounts receivable is going to go up by let's just go ahead and delete this one so I can see one at a time. Let's undo that. Let's just delete it here. And so I'm just going to say the accounts receivable is going to go up by 324. The income is going to go up, increasing net income by 300. It's a credit, but it's increasing net income. And then on the liability side, sales tax payable is going up by the 24. And then we've got the inventory going down by the 200 in dollar amount. And then we've got the cost of goods sold going up. So what does that mean? It means on net income, there's an impact of $100. It went up by 300, down by 200. Net impact on net income was a net increase of 100. The accounts receivable went up by the amount plus the sales tax, 324, that we're going to have to then track on a subledger by customer to try to collect on it. The difference went to the sales tax payable, and that I'm going to have to track in like a payable account, sales tax payable, because I'm going to have to pay it to the government who forced us to collect that 24. Now note, you might say, hey, look, why don't I have $300 of income? Why don't I record $324 of income and then record sales tax expense of $24? That would make sense if we try to say that the sales tax is a normal business expense, but the government is trying to say it's not. They're trying to say you're just a collection person. So we're not charging you a tax, we're just making you the tax collector is the idea. So therefore it's off income statement, and they put it on the books as this liability. That's how they want to see it, basically. Okay, so that's what we do. And then we have the inventories going down. Notice the inventory is going down in dollar amount here, but I'm also going to have to track the fact that it goes down in units with a subledger tracking the inventory by unit. All right, so let's go back on over and say, okay, that's kind of a lot going on. Let's save it and close it and then check it out. So if I save it and close it and I go to my balance sheet, run it, and we go in, is that my balance sheet? That's not, yeah, it is. Let's go into the accounts receivable. And what do we got? What do we got? There it is, customer number 2. There's the invoice. It's on there for $324. That's the full amount, including the sales tax, closing that up, and then going back. The other side's on the income statement. Run it to refresh it. This time it went into a sale of product, 300. So that's in there for 300. That does not include the sales tax. That's just our side of the transaction, not including the sales tax. The 24 is the difference. So if I go back, and then go back to the balance sheet, that's on the liability side for the Board of Equalization, which is the vendor who we pay, the government in this case, because it's in California. There's the $24 difference. So that ties out now. Debits equal the credits, or the double entry accounting system. Assets are going to equal liabilities plus equity with that transaction. But we also have inventory that's going to be going down. So here's our inventory account. If I go into that, it's going to be going down by 200. Note that 200 is not on the books. It's not on the invoice, because we don't put that amount on the invoice, such as or similar to when you check something out at a grocery store. You don't see the sales, the cost of goods sold, how much it cost them. You only see the sales price, but it's being recorded at that point. Let's go back and back. The other side's going to the invoice for the cost of goods sold. Cost of goods sold, there's the 200 here. All right, let's go back to the balance sheet. Also, we've got accounts receivable that's being tracked by who we sold it to, which would be on the subledger. So if I update the subledger here for the accounts receivable, we're going to have customer 2 is now in place. So if I track it by customer, we see 5,805.52 ties out to what's on the balance sheet, 5,805.52. We would more likely track that internally on the first tab under the sales, under most likely invoices, sorting the invoices by not due yet, and we can then find our invoice here that we can then hopefully receive payment on, or track it by customer and then see our customer down here that has not yet paid us. We're looking by customer, open invoices, and then we've got customer 2. There it is, boom. And then if I go into that customer, we see, of course, the invoice. All right, going back, we also need to track this inventory by subledger. So if I go back to the first tab, I'm going to go down to the reports, and I like to just type it in. This is going to be inventory valuation summary report. And so date, let's bring it up and then run it. So there we have our inventory, 3 units left because we put 5 units on the books when we added the inventory, and then we sold 2 of them. and that adds up to a dollar amount of $896.25. If I go to the balance sheet, there's the $896.25. So that is that. So actually, an invoice, particularly if there's going to be inventory, is actually quite a complicated form in terms of everything that's happening, but should be very easy to input if everything has been set up properly, meaning we properly set up the items in particular, as well as sales tax or any kind of consumption tax, if that's going to be applicable. If that's the case, then the idea is that when people do the data input over here for the invoice, it could be a stupid kid, or not a teenager or something, right? They're not stupid. They're just they just don't know what's going on. They're like, oh, dude, I'm just entering the invoice. They don't know that all the stuff that's happening, but that's okay. That's all they need to know. They just need to get the invoice in there, and because we set up everything properly, it should be easy to do the data input. So that's going to be the basic idea. We'll talk about how to set up the behind-the-scenes stuff more later, which means the item, the sales tax, in the second half of the course when we set up the new company file.